Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today we're looking at stock name, the AI-driven workflow automation company.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. Look, we're seeing a company at a really critical inflection point. They're moving away from that classic high-growth cash burn model.
And into something more like financial maturity.
Exactly. It's a story of transition. For years, it was all about growth at any cost, but now we're seeing that growth paired with some pretty serious cost discipline.
And you can see that right on the top line. The revenue growth last year was just explosive.
It really was. Full year 2024 revenue hit $16.3 million. That's a 52% increase year over year.
Which was well ahead of what most analysts were expecting, right?
Oh, absolutely. But you know, what's more important for you to understand here isn't just the raw number, it's the quality of that revenue. Meaning it's coming from the right places. Enterprise SaaS subscriptions now make up 73% of the total. That's sticky recurring income.
Not just one-off projects. And I saw the average contract value, the ACV, is also climbing pretty fast.
Yep, up 29% to 112,000 pounds. It tells you that clients are signing bigger deals and they're sticking around. They're seeing the value.
Which brings us to the margin story.
Yeah.
Because usually when a company's growing this fast, the margins, they tend to suffer.
They do. They get inefficient. But here, we saw the opposite. Gross margin expanded dramatically. It hit 74.1% in fiscal 2024.
Okay, so how? What's the secret there? What do they actually do to make that happen?
It all comes down to their tech. They made two really smart moves. First, they finished migrating all of their legacy clients to their new cloud-native AI engine.
What did that do for the bottom line?
It was huge. That one move cut their infrastructure and hosting costs by 32%.
32%? Wow.
Yeah, that's not a small saving. That's a structural change to their cost base.
Yeah.
And the second thing they did, they automated customer onboarding. I mean, think about how much labor that usually takes. They used AI to basically remove that cost, saving an estimated 1.9 million pounds a year.
So you've got hosting costs down by a third, and you're saving almost 2 million pounds on implementation.
That's it. And that's how they took their operating margin from a negative 19.1% all the way to negative 8.4% in 1 year.
An incredible swing. And I guess that all flows directly to the most important metric of all.
Free cash flow, absolutely. Q4 2024 was their first ever full quarter of positive free cash flow. They generated 1.1 million.
So the whole narrative just shifts. It's no longer about survival.
It's about profitable scaling, and they have the balance sheet to do it. They're sitting on 12.6 million in cash with almost no debt. They're fully financed.
Okay, so that's the financial picture. It's strong. But in a space this crowded, what's their actual competitive moat? What stops someone else from doing the same thing?
It comes down to their core tech. They have this patent-pending multimodal AI orchestration layer.
All right, break that down. What does that jargon actually mean for a customer?
It means speed and simplicity. It lets them automate that whole procurement-to-pay process without needing any custom code.
And that no custom code part is the key differentiator.
It's the absolute death knell for their rivals. Look at companies like UiPath or Automation Anywhere. Their deployments are super heavy on consultants. It takes months. It's expensive. It's risky.
So stock name just sidesteps all of that.
Pretty much. And that gives them their biggest weapon. Their average onboarding time is 18 days.
18 days compared to what, 90 plus for the competition?
Exactly. A 60% faster deployment. If you're a public sector buyer, you don't want a 3-month project. You want a solution that works in less than 3 weeks.
Which gives them a huge advantage in that specific market.
A massive one. And they've leveraged it smartly. They have exclusivity agreements with 7 UK regional procurement hubs. It's like a built-in sales pipeline.
So the fundamentals are there. How is the market reacting? The stock's technical setup seems to be reflecting this bullish story.
The chart looks very constructive, yeah. You had the Golden Cross confirm back in January, which is a big long-term signal.
That's the 50-day moving average crossing above the 200-day.
That's the one. And more recently, it broke out of a classic cup and handle pattern, pushing above that £1.35 resistance level.
And what's the target on a pattern like that?
Based on the pattern's depth, you're looking at a projected target somewhere in the £1.85 to £2 range. So significant potential upside from here.
And it seems like the big money is starting to agree.
It does. Institutional ownership has been climbing. It's up to 38.7%. And you're seeing some key institutions adding to their positions.
But nothing shows conviction quite like insiders buying.
Nothing. And the CEO bought 250,000 shares back in February at about £1.08 a share. It's a huge vote of confidence. He clearly believes the turnaround is real and that the stock is cheap.
Okay, so we have this overwhelmingly positive picture. Great financials, strong moat, insider conviction. But there's a catch for the near term, isn't there?
There is. That's the reality check. The last couple of months have been quiet, no major news, no big updates. So one view is that the immediate outlook is sort of neutral to slightly bearish. The market is just waiting.
Waiting for what?
Waiting for the next big catalyst.
What?
And that is the Q1 2025 earnings release on May 15th. This is the moment of truth.
And I saw there's a huge disagreement on what to expect.
A massive gap. You've got one consensus estimate calling for revenue between 3.3 and 3.5 million pounds, but then there's a much more bullish analysis looking for 5.2 million pounds.
That is a giant range. The stock could swing 30% either way, depending on where they land.
For sure. And it's not just the revenue number. Everyone will be watching the gross margin. Can they keep it above, say, 58%? And they'll be watching the EBITDA loss. The hope is that it narrows again from that negative 1.1 million in Q4.
So May 15th is the big day. Are there any other catalysts on the calendar before or after that?
Yes, a few big ones. The day before earnings, on May 14th, is their investor day. That's where they're expected to lay out their EU expansion plans.
For France and Germany.
Right. And they'll also likely demo their new platform, Auto Procure 3.0. Then in June, they're at the Gartner Procurement Tech Summit.
Okay. What's the significance of that?
They're expected to unveil an API for the EU's invoicing mandate. It's a key regulatory hurdle in Europe, so showing they have a simple solution could really open up that market.
We should probably also mention the rumors. The market chatter.
It's important to stick to what's confirmed. You hear things about a possible equity raise or a strategic partnership, but for you as the listener, it's key to know there's no credible market chatter on that right now. Focus on the May and June dates.
Good advice. Let's talk about the biggest long-term tailwind, though. The regulatory one.
This could be a genuine game changer. It's the UK Procurement Act 2025. The deadline for compliance is around June 30th.
And stock name is in a good position for this.
A very good position. The thinking is they could be one of the first to get the official AI-ready certification under this new law.
And getting that certification, what does it do for them?
It could create a massive regulatory moat. It might effectively become a requirement for public sector contracts. So any government body looking to buy this kind of software would have to look at certified vendors like them first.
Okay, so let's pivot to the biggest risk. Every bull case has one. Here, it seems to be client concentration.
It is. It's a legitimate concern. Their top 5 clients make up 43% of their revenue. Losing even one of those would hurt a lot.
So what's the mitigation there? How do you get comfortable with that?
You look at who those clients are. They're mostly public sector bodies, not volatile private companies. And they're on long-term contracts, averaging 3.7 years.
So they're stable.
Very stable, which is why their retention rate is so high at 92%. Plus, the company has a 1.5 million share buyback program in place, which provides a bit of a safety net for the stock price.
So to sum it up for the listener, you have this core conflict. On one side, the fundamentals look incredible: growth, profitability, positive cash flow. But on the other, you have this short-term waiting game for the next catalyst.
What stands out here is the transition. We're watching an AI company that has achieved positive free cash flow and institutional support while locking down a crucial regulatory moat in the UK public sector. The question for you as a learner and investor is whether the short-term wait-and-see phase presents an opportunity before the major regulatory tailwind hits this summer.
Thanks for tuning in to Smart Wealth with Joshua. We'll be tracking stock names' progress, and we'll be back soon with more analysis.